Hey guys, I'm Parma Srinivas and I have raised a new YouTube channel focusing on commerce subjects in the name of Commerce Study Zone 121@gmail.com, and the subjects which I'm going to cover here will be helpful for the pre-university guys, undergraduates, postgraduates, and also for the professional courses. And the topic that I'm going to pick it up today is auditing. And what auditing majorly focuses today is about nature, scope, and significance. And before we knowing what is auditing, what is the nature of auditing, what is the scope of auditing, and how significant auditing is. So, the evolution of auditing. Something has brought up the concept of auditing. So how did that come into picture? We'll just have an overview or a brief introduction of evolution of auditing. In 1494, a French mathematician called Luca Pacioli introduced the concept of double entry system and the concept of auditing. The double entry system, as you are all aware, that every debit will have a corresponding credit and every credit will have a corresponding debit. And this was chapter number 3 in accountancy of the first PUC. And the concept of auditing will be explained down the line in the different sessions. In India, the base of sophisticated auditing was found in the reigns of Maurya, Guptas, and Mughals too. Interesting. So how did this happen? So I assume by then it was a barter system of transaction wherein goods were exchanged in terms of goods. But let me get into a simple example. A person called A has come into market. I met a person called B, where A proposes an agreement saying that I have a bag of wheat, but I want a bag of rice in exchange. So B agrees to it. But how do I ensure that wheat and a bag of rice actually weighing the same? Is actually in a good quantity or a quality. So in that way, they used to call somebody who was walking around in the market. Let me take the person named C, and C used to come, listen to the words of A and B, and then verifies through his eyesight, through his whatsoever knowledge he has, and then confirms, saying that yes, you both can go ahead and proceed and exchange your goods. And that's how the concept of auditing came into picture. We all know that 18th century was also named as Industrial Revolution. The small set of industries, the homemade products were then moved to an industry concept, where a big industry came into picture. What was actually manufactured, say for example, pickles were manufactured in household, and that became an industry, pickle manufacturing industry. So in that way, due to the change in the nature, size, and type of business, that necessitated an evaluation of transaction that's been conducted, took place, or held by a staff or representatives of the industry. As an impact, then again another concept got evolved, that is called the separate entity concept, wherein industry was treated as in one entity and the owner was treated as another entity, and industry was represented by the owner's representative. So to ensure that whatever representatives are representing, are depicting, are projecting are very much true and fair, there came something called auditing. As a result of practice, to evaluate, to interpret, and to draft a report by an independent personality called auditor has come into place. After all this, we all know that there was a famous act called Companies Act 1956, but many of us are unaware that the first legislation towards the companies was passed in the year 1857 in the name of Joint Stock Companies Act. And this introduced the concept of auditing. However, it was at the option of industry or a company. If the company wants its accounts to be audited, well and good. If the company doesn't want its accounts to be audited, well and good. That is how the legislation was passed in the year 1857. But auditing was made compulsory in the Companies Act 1913. Companies Act 1956 replaced Companies Act 1913, which not just made audit very much compulsory, but the Act of 1956 and the subsequent amendments made it compulsory to seek to ensure the auditing is happening only by an independent professional, and he or she should be qualified to be a statutory auditor. In the amendment of 1956 Companies Act, it also made the cost audit as a compulsory audit along with a statutory audit. Furthermore, Income Tax Act 1961 was amended in the year 1984 and introduced the concept of tax audit, sales audit, that is value-added tax audit, Trust Act, Cooperative Societies Act. So, audit day by day has increased its vastness, has increased its scope, strength, and the strength started growing. The Central Excise Act of 1944 provided a special provision to have a special valuation added under audit under Section 14A and Section 14AA for evaluation, and central value added tax was introduced with effect from May 26, 1955 to May 14, 1997. So what are the basics of auditing? We know the evolution now. To give a just 1494 was a year where the concept of auditing was actually described, and it was by then like an unsung hero. Auditing was in place at the times of Mauryas, Mughals and Guptas. However, the auditing came into picture only in 18th century. So this was the basic gist of auditing, and the basics of auditing was as below. So we know that auditing, or the word audit, has to be derived from some other language, or it has to be derived from any other language. And in that way, audit is derived from a Latin word called audire, which stands as listen. In the previous example, I gave an example or instance of a barter system where person A and a person B gets into a transaction, and person C will ensure that the transaction is happening quite right. So in that way, Taylor and Perry, has noted a famous definition as audit is an investigation of some statements and figures involving an examination and certain evidences so as to enable the auditor to make a report on the statement. So it's very much clear where it says audit is an investigation of some statement. So in the previous example, if I just go back and pick it up, person C was actually examining the statements of person A and person B, and involving an examination of certain evidences. He was actually looking onto the two backs, and he was reporting, saying that yes, you can go for a transaction. Professor Montgomery goes much deeper than Taylor and Perry and states that auditing is a systematic examination of books and records of business or other organization in order to ascertain or verify and to report upon the facts regarding the financial operations and results thereof. So, in the previous definition, auditing is an investigation of some statement. But now, Professor Montgomery speaks as it is a systematic examination of books and records of business or organization in order to ascertain and verify, just to interpret and check if those statements or transactions are entered right, no misstatements, no mispresentations, no frauds, no errors, and to report the facts. The facts is nothing but an observation of an auditor, which will be input in a statement called auditor's report, where it consists the details about the financial operations and also results and the observations. In India, auditing is majorly governed by an institute called an Institute of Chartered Accountants of India, and auditing is an accumulation and evaluation of evidences about an information to determine and report on the degree of correspondence between information and established criteria. Audit should be done by a competent independent person. So as I told, Institute of Chartered Accountants of India is a body, statutory body, which majorly governs the auditing and auditing principles and accounting standards in India. And it interprets auditing in such a way that it's an accumulation of evidences. It's an accumulation and evaluation of evidences about the information that's been provided, and to determine the true and fairness of it, and report on the degree of correspondence, and reporting to the towards the weightage towards it, and reporting the observations that we found between the information and established criteria. And it makes very clear that auditing should be done by a competent independent person. Auditing should be made by a qualified person. Moving on, so to summarize what auditing is: an intelligent and critical examination of books of accounts. It is to be performed by an independent and qualified personality. Examination of evidences such as vouchers, and documents it, records it, information, and explanation received by the client. Whenever there is a transaction that he seeks for a clarification, he goes to the voucher, he goes to the invoices, verifies towards it, he documents his observation that he has verified, and also he notes down the explanation that's been given by the client or the client's representative in his audit notes. After all these evidences has been verified, auditor should satisfy himself on the report saying that yes, the financial statements after me auditing depicts very true and fair statement, or if there is any observation towards it. And he authenticates that the financial statements are prepared for a particular period and good to be used for further purposes. And he also reports that the financial statements, including profit and loss account and balance sheet, reveals a very true and fair value in the financial year. Any feedback or any areas of improvement, any red areas or grey areas that a company might have to improve, so that will be given in auditor's report. And a conclusion of it is: audit is an evaluation and systematic examination of records to ensure financial statements depicts true and fair value, and is done by an independent and qualified personality. So in summary, while concluding, it makes very much simple saying that auditing is an evaluation and systematic examination of records, and to ensure that the financial statements are giving true and fair value, and is done, as stated earlier, by an independent and a qualified personality. In addition, auditor is not just concerned about financial accounting records. Audit has extended its scope. Audit has extended its branches it also seeks and ensures that the firm or the auditee firm is actually in compliance of laws, costing records are maintained properly, operations are online, performance has been consistent or has been improving for a stated purpose. Stated purpose is nothing but your memorandum of association, articles of association, which says what a company is formed for and what are its purposes. It should be noted that the information under audit need not necessarily be accounting. It also includes the compliance of laws, costing records, operation, performance. However, all this information should have been in a specified form, in a verifiable form. If it is not verifiable, then auditor will mention the same in his audit report. That should be a basic standard criteria for evaluation, which is why standards of auditing are in existence, which is why accounting principles and concepts are in existence. So which will be concentrated on the further coming session. And auditor should be competent, independent and qualified. Apologies, the slide says that audition, it's a small correction, it is auditor should be competent, independent and qualified. I've been speaking directly or indirectly that the scope of auditing has been vast and has been expanded. So it says here as an auditor by nature is a watchdog, trustee of nation's finances. So what exactly the watchdog is? What is a trustee of nation's finance is? An auditor digs into the accounts of the company, digs into the books of accounts. He verifies the statements, he verifies the evidences, and he'll get into a conclusion stating that yes, the reports are actually projecting the true and fair value. If not, then he will go for his observations, gives the feedback in his auditor's report. And just to make it clear that auditor will nowhere be related to the company that he is going to be auditing. He should be a third person. And he holds no interest towards the company. He is an independent personality. He flags up the issues if there is any malpractices or malfunctioning in a company. And any auditor's report will have a most reliability, most trustability in the nation. In that way, auditor is a watchdog. In that way, auditor is a trustee of nation's finance. And auditing day by day has extended its scopes in cost, operation, performances, management, internal energy audit, VAT, government audit too. So who is an auditor? A person conducting the process of audit and who is a professionally qualified, independent, competent, independent personality. The person conducting audit should be very professionally qualified. He should be a CA or a CMA. He should be an independent personality. He should be competent. The qualities of an auditor. He must possess the knowledge on various disciplines. Economics, mathematics, statistics. An auditor should be aware of it. Must possess integrity. He should never give up his integrity, he or she. One's client data should not be shared with other clients. One's client data should not be spoken outside the room. He should be objective, should be independent in his or her approach. Must be aware of general principles and law governing the auditing firm. If a company, if it's going to audit a trust, he should be aware of the Prestige Act. If he's going to audit a cooperative society, he should be knowing the Cooperative Societies Act. The technical knowledge is necessary to have an audit. Meanwhile, it should also be backed by human qualities. So what are the human qualities? Human qualities is nothing but being straightforward, being honest. Right? So that is the difference between auditing and investigation. Many people use it in a way that auditing is nothing but an investigation. But auditing and investigation are not one and the same. Audit. Independent and systematic examination of evidence and accounting are according to the GAAP. GAAP is nothing but generally accepted accounting principles. However, investigation is an examination of accounts and records with a view to ascertain the facts. In auditing, the examination of evidences and accounting happens and in line to confirm that whether they are in generally accepted accounting principle standards. But the investigation is not as such. Investigation involves examination of accounts and records with only certain aspects to ensure that there is no fraud in that particular transaction. The scope of audit is determined by law. However, in case of private audit, the scope is determined by the proprietor or owner. But investigation is limited to the fact or the areas of the concern. Auditing is to verify and ensure that the financial statements are depicting true and fair value. And investigation is for special purposes. Only for special purposes. It doubts some transaction, then it goes and digs where is evidence of it, where is the voucher for it, where is an invoice for it. And auditing or evaluation of evidences in auditing are based on persuasive evidences. Persuasive evidences are those which predict or which pursues a person looking at it to be a true and fair, to believe, to do something. An investigation is done on the basis of conclusive evidences and the substantial evidences. In an investigation, if an auditor finds there is something which has actually been malpracticed, say for example, an amount is doubled in an invoice for no reason, that's a conclusive evidence for him. And there is a supporting bank transaction which says that an excess amount has been transferred to his own account. That's a substantial evidence for him that there is a fraud. So what are the aspects of auditing? Accounting and internal control system. An auditor should concentrate on certain aspects that accounting and internal control system of that accounting department or any department is very much tight, and there's no scope for any fraud, any errors, any misrepresentation. He examines the books of accounts and e-records. E-records is nothing but your accounting software where accounting transaction has been entered. And those books of accounts are in compliance with GAAP, generally accepted accounting principles, according to the accounting standards and applicable regulations. Regulations are nothing but a law governing the auditing firm and reporting the same. So, just to do a gist of aspects of accounting, auditing, accounting and internal control system will be verified. He verifies the books of accounts to ensure that they are in compliance with the GAAP, the regulations that they are bounded to be, and accounting standards are being followed. And he reports all his observations in a statement called Auditor's Report. Objectives of auditing. So the objectives of auditing can be classified as primary and secondary. And the primary objective is to ensure that they depict the true and fair value of financial statements. Throughout the session, throughout the auditing subject, these are the common words that we get to hear: that vouching, evaluation, examination, true and fair value, financial statements, competent, independent. So these are the terminologies that's very much common in the subject called auditing, and ensure that they depict true and fair value of financial statements. The secondary object, there are two. The secondary object is to ensure that they are not just depicting the true and fair value, but they are actually in line with the generally accepted accounting principles, and there are no errors and frauds on it, or there are no misrepresentations on it. So what are the basic principles of audit? Integrity, objectivity, and independence. Auditor should hold integrity at its height. It should be very much objective, that I'm going to do an audit and it's going to be 100% accurate, and I'm not influenced by anyone. And that way he's an independent personality. He should maintain the confidentiality of the client information that he's going to audit. If he's going for an auditee firm A, and if he also goes for an auditee firm B, and he is auditor for both the firms, he should not be disclosing auditee firm A information to auditee firm B. Skills and competence, he should necessarily be holding the skills of audit. He should be competent, he should be qualified. He should also supervise his subordinates' work. That is nothing but supervise the work performed by others. He should document all the evidences that he has found. He should list it and then document all the evidence that he has found. Most importantly, he has to plan his auditing while he gets into auditing firm, by determining the nature of business the company holds, by determining the size of the company, by determining the turnover of the company. He should plan his or her auditing tenure, his or her auditing aspects, his or her auditing implementation. And the basic principles of audit also involves audit evidences, documenting the audit evidences that he has found. He also needs to ensure that accounting systems and internal control are very much in place. After all this, he provides a conclusion and reporting. And finally, he satisfies himself, or she satisfies herself, that the company is actually projecting true and fair value in its financial statements. So what are the significance of audit? Why is it so important to have an audit? Why statutory has made it so compulsory to have an audit? There are three aspects: from the legal point of view, from the internal control point of view, and from the external point of view, external affairs point of view. In the legal point, filing the income tax, borrowing money from external sources, statement of insurance claims, sales tax payment, and action against bankruptcy. From the internal control point of view, discovery of errors and frauds, moral check of employees, advice to management, and uniformity of accounts. From external affairs point of view, settlement of accounts, valuation of assets and goodwill, future run of business. So from the legal point of view, filing income tax is very much important. Filing income tax is very much mandatory as per Income Tax Act 1961. So audited financial statements, since it depicts the true and fair value of profit and loss account and balance sheet, then a tax payable amount can also be determined from the audited financial statement. Audited financial statements guarantees the external sources of money, saying that this company is actually in a very good position. I can be a creditor to this firm. Audited financial statements can act as a statement of insurance claims if there is any loss or damage due to certain unforeseen activities by nature of God, the activity of God, and sales tax payment. Action against bankruptcy is if a firm is actually going towards a bankruptcy, and what are the actions that needs to be done to fulfill the losses of the shareholders, of the creditors, and how to retain the assets of the company. How can a company be liquidated? And from internal control perspective, discovery of errors and frauds. It goes to such an extent that every activity, every department has actually done well and there are no errors and frauds. There's involved in moral check of employees. Are they loyal to the company? Are they not loyal to the company? Advice to the management if there is any changes. And accounts that are maintained are uniformly maintained. For example, of uniformity of accounts, if a machinery is actually being used in depreciation by straight line method, and there is similar machinery which is again created in straight line basis or straight line method of depreciation. It shouldn't be a case where machine A is actually being treated in straight line depreciation method and machine B of the similar nature is treated in return on value or an annuity method of depreciation. That should be a uniformity of accounts. And external affairs, settlement of accounts from the debtor's perspective, from the creditor's perspective, to the debenture holders. And the audited financial statements will actually help in valuation of assets and goodwill. It also projects the future trend of a business. After all this, there comes the last part of this session as inherent limitations of auditing. We all know that auditor is responsible for forming and expressing his or her view on the financial statement, but the responsibility of preparing the accounting statements are still with the company itself. So if they use their brains 2 steps extra than an auditor and then prepare the persuasive evidences about any transaction, about any cash payment, which shows that they are actually very much true, then auditor cannot help in determining such kind of transaction. So in that way, it says that auditing does not guarantee all the material misstatements are detected because of test nature. Auditor might pick up the samples and those samples may be 100%. And since the evidences are of persuasive in nature, he cannot determine if there is a misstatement, if there is a malpractice, if there is a malfunction, errors and frauds. And also, when an internal control system has been designed in a company, that will itself has its own inherent limitation which auditor cannot help with. So in that way, auditor cannot depict the material misstatements, if any. There's something called professional skepticism. The professional skepticism is nothing but an approach that if something is wrong, this helps in identifying and evaluating the matters that increase the risk of material misstatements, resulting in the errors and frauds, circumstances that make the auditor to suspect the material misstatement. A professional skepticism is nothing but he identifies or evaluates the matters or the things that increase the risk of material representation, resulting in the errors and fraud, and circumstances that lead the auditor to suspect the material misstatements. And professional skepticism will also involve in questioning the management's representation reliability. However, auditor is not entitled to enforce his professional skepticism. An auditor is just only entitled to accept the records and documents as genuine until and unless there are some evidence to the contrary. So he cannot express his professional skepticism, wherein he can go and question the reliability of the representatives, where he gets in circumstances to question the material misstatement. He cannot suspect, because auditor has clearly been told you should take all the records as genuine until and unless there is a contrary evidence. And the material misstatements or the increase or risk of material misstatements cannot be avoided because of the lack of professional skepticism. So these are the inherent nature of limitations of auditing. So thank you. So keep watching the space for the further sessions of auditing and various commerce subjects. And you can drop your feedback to commercestudyzone121@gmail.com. Thank you.